gives me great pleasure to bring on board Anuj Kumar, Managing Director and CEO of CAMS. Good morning. Always a pleasure to have you on ET Now. Thank you for joining us. It's the tagline "mutual funds sahi hai," I think really applies to your business, right? I mean, as mutual funds are growing, you will grow. As SIPs will grow, new and new folios will get added. As they will grow, your business will grow. So can I say that mutual funds sahi hai and CAMS is also sahi jagah par hai?
Hey, morning, Nikunj, and thanks for having me over on the show. No, I would agree with you. For years, our business has been tightly tied at the hip with the capital markets. And within the capital markets to mutual funds, about 86-87% of the revenue is tied to the movement of that industry. I think over the last many years, the broadening of distribution, the acceptance of the product has grown. So absolutely right that our fortunes are dependent on this market, and absolutely. So I would concur with what you said.
If one looks at the quarter gone by, margins have expanded, but the EBITDA growth is in single digit. For a sector which is growing in double digit, why your EBITDA growth is single digit?
Well, I would say if you look at a fair year-to-year comparison, the second quarter had revenue grow by 32%. That is perhaps the best number we posted in life. And it's a diversified book because MF revenue grew by about close to 33%, non-MF grew by about 31%, blended 32. EBITDA, absolute EBITDA year-on-year basis grew almost 40%. Again, that's perhaps in my 9 years, one of the best logging in of profit growth that we saw. EBITDA percentage grew to just short of 47%. So I think those are encouraging numbers. We believe that with the market, of course, there's been some correction and some flattening of the mood in the last 2 months. But as things come back, we should be holding our projections. And this year, which is FY25, should be one of the strongest years in the last 5-6 years in the history of the company.
So, if I may, given that it has been a pretty decent, quarter gone by, do you think that this 20% revenue guidance can be maintained?
We think so. If you see last quarter, like I said, revenue grew 32%. In this quarter, we will moderate that outlook a little. So it obviously will not be in the 30s, but it should certainly be mid to late 20s, like any figure between 26, 27, 28. Similarly, profit growth, which was 40% last quarter, again, we are moderating. It should be in the mid 30s. So I think for the whole year, it is quite possible to deliver a mid 20s revenue growth and a early to mid 30s profit growth, which again, I would say there are good times and bad times during the year, but as a consolidated 1 year, it will be perhaps the best year in the last 5-6 years.
Can I say that right now the entire space which you represent, essentially the back office for mutual funds, that is more like a two-player market, CAMS on one side and Kfin on the other side, and there is a very scarce possibility that there could be a disruption or entrant or a number three player who could emerge?
Yeah, for the medium term, I think that's a correct conclusion to come to. It's a very complex, nuanced business, very multi-layered execution. Significantly deep SME-ship is needed. The platform has to be very strong and is built over decades, not over years. So that's a safe assumption that for some time, this market could remain in terms of competitive intensity, the way you described.
How else are you looking at utilizing your cash flow? Because your business is such that it does not require too much of capex commitment. Margins are strong, cash flows are strong, return on equity is strong. But there would be a point beyond which the base effect for the existing business would kick in, which means you need to diversify, you need to add more business lines. How are you planning to do that?
So today, if you see, the book is essentially mutual funds about 86%. Everything else is about 14%, which includes a payments business, KRA, AIF, and private equity. And then there are 2 or 3 other business lines, including account aggregator and insurance repository. We believe our hands are full. We believe that we are in the right market, which is India domestic, that we have the right business lines. And like I said, in the last 3 years, we made investments in the other businesses outside of MF. And some of the revenue growth, which you saw, was in the early 30s in the last quarter and should remain in the mid to high 20s this year. Vindicates the fact that we have done the right things. Over a period of time, you're right, the base effect will start kicking in. But we are confident that we have the right diversification at the business level. From a cash perspective, we've been a high dividend company. We will make investments as and when they come by, but we are in no rush to just deploy the cash in something inorganic unless it completely abides by the character and focus of the company. The focus of the company has been execution and platforms and cash generation. We want to bring something like that into the fold and not just any business that appeals to us just because we have cash.
So for next 3 years, at what rate you expect your mutual fund business to grow at, and at what rate you expect a non-mutual fund business to grow at?
So MF, if you take earnings, which is profits, we are calling mid-teens, so 14-15% growth in the next 3 years. Non-MF, we are calling over a 20% growth, blended about a 17% earnings growth is what the company can deliver. Everything else remaining okay.
The way technology is moving and the way prices are coming down, whether it is back office management, cloud, connectivity, AI, are you at a cusp of a strong operating leverage benefits which would kick in? And I'm just expanding this question for the benefit of our viewers. When I was a schoolboy, I would buy a pen drive for 100 rupees 1 GB. Now I have a cloud of 1 TGB on my phone where I pay 70 rupees a month. I'm sure that kind of a benefit would start kicking in for a for a company like CAMS. Are you there in terms of adaptation of AI, technology, hardware, and you could actually be a big beneficiary because of this entire functionality both on the hardware side and also on the software side?
At the macro level, yes, but I must also tell you that our historical operating leverage has shown up in the way of about 1% profit expansion every year. So it will remain in the 1 to 1.5% range. We don't expect it will pick up too much. Just from a broader execution perspective, we run 3 data centers. We run them at 2x of the past peak expected capacity. We're setting up a 4th air-gap data center just to keep things like malwares away. We have significant and deep investments in security of all kind. So do keep in mind that a lot of the requirements emerging from a digital-only world require a lot of multi-layering of investments, both in security and in infrastructure, and that is a cycle that we and everyone else is going through. So we expect that while the operating leverage will certainly kick in, it will be of the order of 1 to 1.5% a year, but nothing significantly more than that.
Me to introduce the company for someone who's watching the show for the first time. If I say that CAMS is more like a back office management company for mutual fund, and whether it is CAMS or whether it is Kfin, every mutual fund in a sense will have to go to one or the other service provider. So as long as the mutual fund industry is growing, your business will grow. Can I say this is a very fair and easy summary of your business?
It is. It is very tough for anyone to insource this or do it themselves. So it's been a 100% outsourced model, and we expect it will continue like that for some time.
When you see advent of, let's say, geofinancial services, they're talking about distribution, they have technology, they have strong backend. Could that be a challenge that a new large competition or competitor could come in and they may directly start managing their backend, they may directly start having different ends where they in a sense may not require your services? Could there be disruption coming from Geo? I'm just thinking aloud.
Like I said, it's a very multi-layered, nuanced, regulated business. You require significant and long-term investments in the platform and building the digital infrastructure. And then to sell at the price at which we sell, where effectively our per folio per account price is of the order of about 120 rupees, it's very difficult to match these economies, match the scale, and match just the quality of the infrastructure we built. So it will take some time before somebody just jumps in and starts doing it themselves.
The global parallels, what are the global parallels, let's say in United States? How many players are there in this entire mutual fund banking business? Is there a two-player industry also if you look at European and US examples? I'm just trying to make this conversation slightly more relevant for our viewers who are prospective investors.
So overseas too, I think it's a bit of a lumped business. While some commercial banks offer this as part of the retail banking suite, and the business is run as an omnibus folio and not individual investor folios overseas. I think players like BNY Mellon, State Street, Computershare in Australia are good examples of companies who do this kind of work.
Sure. I understand that the moat is a bit, quite large as far as your services is concerned. But given the fact that you are running at very, lucrative margin levels, I think it's above 46%. What's the way forward on this? Are you looking at letting go of some of the margins and pricing to get more relationships, get more clients onboarded, or you think the margins can actually head to 48 to 50% given the operating leverage Nikunj was talking about?
So like I said, we've been in a market share, and market share is share of AUM, range of about 70% for the last 3 or 4 years. So we believe that's competitive, and we are defenders. In the new bids, we continue to win 70 to 80% of the new bids, so we are happy with the performance. I think we are focused on execution. We're focused on helping our clients scale their businesses and drive high levels of investor sat in the industry, which is what we are doing. From a margin expansion perspective, like I said, despite all the economies, etc., and scale benefits, it will be of the order of about 1 to 1.5% a year.
All right, gonna let you go on that note. Thank you so much for taking time out and joining in. That's the word coming in from the management of CAMS.
If you like this video, then like, share and subscribe to ET Now.